Alrighty, so welcome back to the International Wealth Builders Association radio talk show. I'm your host, Toya Tillett on KCAA Broadcasting Network, and I'm back with my special guest, Michelle Estrella. She is the branch manager of Guild Mortgage in the city of Wildomar. So before the break, we were just talking about, a little bit of her history of how she got into the lending industry, how she, has been there for 39 years. I definitely want to get more into that, like how, you gotta love it to do it for that long.
Yeah.
And then she also gave us some information, some really good information on what it takes to qualify for a mortgage for those of you who may be out there looking to purchase your first property or even your second property. Because just because you bought a property before doesn't mean you always know or remember or care what the process was. Because I've had those clients too. I actually had a client come to me and I'm like, okay, remember last time, we did this? And he's like, I don't care what I did last time. You go over this with me. And it's like, okay.
Yeah.
All right.
Yes.
So we had that good information come out just before the break. So now that we're back, I wanted to kind of touch on a subject that's near and dear to my heart because as a self-employed person and a business owner, I find it tougher for those types of clients or those types of people to get qualified for a traditional mortgage. So, Michelle, help me out. How can I get qualified for a mortgage without going to get a W-2 job?
Okay. So obviously the challenge and the good and the bad of being self-employed, there's so many awesome things about being self-employed, but obviously one of the main goals that we might have as a self-employed person is to mitigate our tax exposure. And we also spend a lot of money to make money. So, there's a balance between what is revenue and then what is net income based on the fact that you do have advertising, you do have possibly employees to pay, you do have supplies, you do have office supplies, and you use your vehicle for your work, you use your home for your work, you use all you do like pull from all of that. And so what you pay for to earn a certain amount of money is the deductions that allow you to mitigate your tax exposure. And so what the lender is always going to look at, two things. So 2 years of self-employment is your basic minimum. So again, remember that I keep on saying everything is nuanced. So if you can't take any of this like a hard line, like there's no other way. But your general thing is you have to show 2 years of filed tax returns as a self-employed individual. And we average the net income. So there's different type of businesses. You can be a Schedule C, sole proprietor. You can be an LLC. You can be an S Corp. You can be a corporation. You can be a partnership. But basically, we're going to average the net income from that self-employment over 2 years.
Okay.
Unless it's declining. If last year was great and this year is not, we're going to use this year. Okay. So we won't average declining income, but we will average other income for 2 years. We will add back certain paper losses, but if you basically reported to the IRS or the state that you only earned this amount of the actual revenue that you took in, we can only use that. Okay. So the best thing to do as a self-employed person in preparation for buying a home is to always talk to the tax preparer, and you help people with this to say, how can I mitigate my tax exposure as much as possible while also reporting the most income, and where is that balance? Okay. Okay. Let's face it, you only have to do it for the few years when you want to buy a house. So if in the next years, if you earn a lot more money and you have a lot more write-offs, then you can write off more. But while you're trying to buy a home, you might want to be conservative in how much you write off so that your net income is maximized as much as possible. And then we are going to ask to show that you did pay whatever taxes were owed. So if you file a tax return and you owed $5,000, we want to show the $5,000 paid, and then we use that income for those years. So that's basically for being self-employed, is this balance between mitigating your exposure to paying a lot of taxes and also showing as much positive income that you can as a self-employed person.
Okay. Okay. Now you mentioned something about there's some things you can add back in, like kind of if you can touch on what that is or what that means, like adding
So
back in.
what we would do is we would take, so I'm thinking right now, line 30 of a Schedule C is the basically the bottom line of your profit and loss on
Mhm.
a Schedule C, because a Schedule C is called a profit and loss statement.
Yes.
That's your 1040 form.
Mhm.
So we will take that number, but then we'll look at what else you wrote off. And one thing that we can add back is depletion and depreciation.
Okay.
So if you did take a $10,000 depreciation, we can add that to line number 30. If
Okay.
you have some depletion, we can add that. If you do have some amortization and casualty, we can add that back. Most people don't have that, but just if you did, we could add that back. We
Mhm.
also can look at what you did on the second page of that Schedule C as far as business mileage.
Okay.
So if you wrote off like, 10,000 in mileage at whatever the current rate is, maybe $27 or something, we can put that part back to your income. So there's certain things on that schedule. On, the other tax returns that I mentioned, the S corp, a partnership, and LLC, there might be different things, but it's always, the depreciation and depletion is the most common thing that we can add back.
Okay. Okay.
So
Okay. Well, that's very helpful. So keep that in mind. All my self-employed people out there, my business owners, keep in mind when you're looking to buy a house and you're thinking about it, it's going to be a little bit of a process. So you're going to have to take a year or 2 years, maybe 3 years of time where you're actually going to maybe have to not write off as much as you normally would, and just so you can get yourself in preparation to buy a home. So that is true. I know I do it too sometimes, but it's like I need to write off as much as possible because I don't want to have a big tax bill. But
mhm,
then the drawback is, you don't show enough income to purchase a home. So
right.
there you go. There you have it, folks. You
And
gotta.
we do bank statement programs, so we
Okay, great.
can analyze your bank statements for deposits versus analyzing your tax return.
Oh,
But we
nice.
are going to take into consideration still what you had to spend to make that money. So we're not just going to look at
Okay.
the deposits. We are going to look on, the whole bank statement and see if we can see where you maybe paid yourself or where you had to
Okay.
pay other people out and you had actual hard costs. It's going to
Mhm.
be analyzed a little bit, but it's just not the same as maybe what your tax returns would look like.
Oh, okay. And is there a certain percentage of that income you take from those bank statements?
Well, we do look at all the deposits, and it's can be either looking at the business or the personal bank statements, and each
Okay.
of them have again little bit different criteria whether we're looking at a personal bank statement or a business bank statement, and we are looking at the profit and loss statement for the current year for the business as well. So we're
Okay.
kind of going to see. Like if you have a QuickBooks profit and loss and you've put all of the income and then you actually are showing all that expense and it comes out to, let's say, 52,000,
Mhm.
but your deposits are 80,000 a month, and then you spend $82,000 a month, and so it keeps
Oh,
going
yeah.
down. We're going to be looking at that. So
Okay.
it is in the percentage that we do in the end will really depend on the program.
Okay. Okay. Perfect. And so, with that type of program, with bank statement programs, I know, I've come across a couple of lenders who do that, and sometimes the down payments are a little.
Yes.
What do you guys have for on average for a down payment for a bank statement loan?
So again, then the nuance little things that we look at for down payment is going to be the credit score will offer you a lower down payment, and the credit score and the loan amount. So like if because a lot of these are jumbo programs, the bank statement programs, so they don't do the lower loan amounts. So if you're like from, let's say, in the $1 million purchase price, you might have a down payment, but then if you go up to like 2 million, you're gonna have a larger down payment. So, but basically overall, there are some programs that allow as little as 10% down. Most of them are 20 to 25%, depending on your score and the amount you're borrowing.
Okay, that's kind of what I've been hearing about, or more around the 10 to 25%
Mm-hmm.
range, when it comes to down payments. So pretty much, self-employed people, they're not necessarily going to qualify for some of those traditional down payment assistance programs and things like that, correct?
Correct. I mean, they could, because they still only need to meet the criteria of the FICO score and the debt to income ratio. However, if the program does have an income limit, they would also have to meet that income limit. So for instance, like Cal HFA, the income limit is like 150,000, but the area median income for a lot of Riverside County can be as low as like 80,000. So if you're making 100,000, you're not going to qualify for some of the down payment assistance, but you will possibly qualify for others.
Oh, okay, that's good to know. So I'm going to take notes on that too. Um,
Because a self-employed borrower is not excluded from that type of program, but they still have to meet
okay.
the same criteria: debt to income, FICO score, income. They have to meet those criteria.
Oh, that's awesome. Well, that's really good to know because that's always been one of my things I've been kind of afraid of. I'm like, oh, I don't think I'll qualify if I'm self-employed or I can't get any assistance or get any help. But so that is really awesome. See, I'm learning new things. I'm telling you, 18 years in the business almost, and it's never a dull moment, especially when it comes to lending.
Of course. Yes.
Always learning something new, something different. So, okay. So with that being said, we'll go ahead and we'll take another quick commercial break. And then when we come back, we will talk to Michelle some more about, why 39 years in this business. So we'll see you guys in about 2 minutes.